When you think of the U.S. Treasury, the first things that probably come to mind are government bonds, national debt, and perhaps the occasional news about economic policy changes. However, the U.S. Treasury's influence extends far beyond these broad topics, and its actions directly impact the everyday financial lives of American citizens. From interest rates to taxation policies and national spending, the Treasury has a hand in shaping personal financial decisions. Understanding how the Treasury operates can give you better insight into how your finances are affected by national policies. In this video, we'll explore the top 10 ways the U.S. Treasury influences your personal finances. 1. Interest rates and monetary policy. The U.S. Treasury plays a crucial role in shaping interest rates through its coordination with the Federal Reserve, the nation's central bank. When the Treasury issues bonds to raise funds, it impacts the yield rates, which in turn influence the broader economy. Changes in interest rates affect your personal finances in many ways, particularly with savings accounts, mortgages, and loans. Lower interest rates may encourage more borrowing for things like buying a home or taking out a car loan, whereas higher rates may increase the cost of borrowing. 2. Taxation policies and tax brackets. One of the most direct ways the U.S. Treasury affects your personal finances is through taxation. The Treasury, working in tandem with the Internal Revenue Service, IRS, determines tax policies, such as the rates at which individuals are taxed based on their income. These rates are adjusted periodically, and changes to tax brackets can have a significant impact on your take-home pay. For example, if the Treasury reduces taxes, individuals may see a larger paycheck, whereas a tax increase could reduce disposable income. 3. Social Security and retirement benefits. The Treasury is responsible for funding and managing Social Security programs, which affect your financial planning for retirement. The payroll taxes you pay during your working years are funneled into the Social Security Trust Fund, managed by the Treasury. Any adjustments to the amount of payroll tax or changes to the benefit structure directly affect the retirement income you will receive. Likewise, the Treasury's oversight of Social Security helps ensure that retirees continue to receive regular payments. 4. Government spending and economic stimulus. The U.S. Treasury manages the federal government's spending programs, which influence the economy at large. During times of economic downturn or recession, the Treasury may oversee the distribution of stimulus checks, such as those issued during the COVID-19 pandemic. These programs can provide financial relief to households, helping to maintain consumer spending and stabilize the economy. The Treasury also funds government programs, such as infrastructure projects, which can affect local job markets and income levels. 5. The national debt and borrowing. The Treasury is responsible for managing the national debt by issuing Treasury bonds, bills, and notes. The government borrows money to cover deficits when it spends more than it collects in revenue. This borrowing impacts the economy in various ways, including inflation and interest rates. A rising national debt may also influence future tax policies, as the government may raise taxes or cut spending to manage the debt. This has long-term implications for your own financial planning, especially with regards to savings, investments, and tax expectations. 6. Financial market stability and regulation. The U.S. Treasury helps to maintain financial market stability by regulating and overseeing financial institutions and markets. For example, during the 2008 financial crisis, the Treasury played a key role in stabilizing the banking system and preventing further economic collapse. When financial markets are stable, it is easier for individuals to invest, take out loans, and build wealth. Conversely, market instability can result in decreased investment returns, increased loan rates, and economic uncertainty, all of which can affect your personal finances. 7. Inflation control. Inflation is another area where the Treasury has an indirect influence. The Treasury works alongside the Federal Reserve to manage inflation by adjusting the money supply and issuing government bonds. If inflation rises, the Treasury may implement policies to reduce it, such as increasing interest rates. Inflation erodes purchasing power, meaning you can buy less with the same amount of money. The Treasury's actions to control inflation can directly affect how far your paycheck goes, the cost of goods and services, and your overall budget. 8. Currency value and exchange rates. The Treasury also has a role in managing the value of the U.S. dollar through policies related to national debt, interest rates, and fiscal management. Currency value impacts exchange rates and the cost of imports and exports. If the value of the dollar declines, it can increase the cost of imported goods, which may raise your living expenses. On the other hand, a strong dollar can make goods and services cheaper. The U.S. Treasury's actions in this area affect your purchasing power on both a domestic and global scale. 9. Housing market and mortgage rates. The Treasury's policies can also influence the housing market, particularly through its control over interest rates and mortgage-backed securities. By issuing bonds and influencing the Federal Reserve, the Treasury indirectly impacts mortgage rates. Lower mortgage rates encourage home buying, while higher rates can slow down the housing market. Changes in housing prices, mortgage availability, and lending standards directly affect your ability to purchase a home or refinance an existing mortgage. 10. Financial crisis management and bailouts. In times of financial crisis, the Treasury often steps in to manage bailouts for failing industries or institutions. This was seen during the 2008 financial crisis when the Treasury provided assistance to major banks and automakers. While this may seem far removed from individual finances, the repercussions of these decisions often trickle down to consumers. For instance, bailouts can stabilize financial institutions, ensuring that loans and credit remain available to individuals. However, they may also result in long-term fiscal adjustments that influence taxation or inflation rates. While the U.S. Treasury's primary focus may seem far removed from your daily life, its actions have a profound and far-reaching impact on your personal finances. From the interest rates that affect your loans to the taxes you pay and the economic stability that influences your job security, the Treasury's role in shaping the financial landscape cannot be overstated. By understanding how the Treasury operates, you can make more informed decisions about saving, investing, and managing your finances. Staying aware of national policies and their potential effects on your finances will help you navigate changes in the economy and protect your financial well-being in the long term.